Okay, so welcome back from the exam. This is going to be one of the last sections because after this chapter, right, we're going to actually dive into our case study. Okay, so we're only going to cover the first half of chapter 12, okay, and then tomorrow we'll finish up the rest of chapter 12. But this is going to be one of the last concepts that you're going to be learning because chapter 13 is about closing up the books. So in this case, right, this is basically the last chapter that you'll learn about everything that you need to know about accounting, and that will be payroll. Payroll is going to be one of the largest sections, major core parts of a business, right? Because if you actually really think about it, your business is divided into three sections, right? You have the people that you sell to, you have the people who you buy products from to sell to those customers, and then you have the people who work for you, right? So in this case, employees is going to be one of those costs that are going to be a major part of your business. Then you also have to consider these kind of things, because if you're going to have employees, what are you going to offer them? How are you going to pay them, right? Through compensations. What taxes are going to be involved when having these employees? And what benefits and deductions are you going to be offering and giving to these employees, right? There's a lot of considerations when you are thinking about having employees, okay? Now, these are just the very basic fundamental ones, all right? Now, let's talk about the difference between a social security card and versus an employer identification number. You need to have an employee identification number if you're a business. Now, remember, your social security, right, is what's going to determine when the individual is going to work for you. You need to know what their social security number is so you can go ahead and pay those taxes for that individual, right? So the social security card, right, as we can see here, right, it's distributed by the Social Security Administration, okay? And it's for individuals, right? It's an individual identification number, right? And in the digits, it goes 3, 2, then 4, right? It's a total of 9 numbers, but it goes 3, 2, and then 4. Whereas the employer identification number, this one is more widely used for the IRS, okay? So it's provided by the IRS. And what this employee identification number does is it's a means for the IRS to identify us as a business, right? But it also keeps track of our taxes that we have to pay for being a business. So in this case, a sole proprietor, partnership, corporation, including limited liability companies and other businesses, have to apply for a business identification number. Only exception is going to be anybody who's an independent contractor, right? They own their own business, right? So they have the choice to either use either or Social Security or a employee identification number. But it's always going to be so much easier to separate yourself and be able to tell which one is personal, which is business, by just applying for a business identification number. So once again, the way that the employer identification number actually looks like is going to be 2 digits, then 7 digits afterwards, okay? So that's how you can tell the difference between an individual versus a business, right? 2, then 7 is a business. An individual is 3, 2, and 4, okay? So again, these are ways that we identify establishment of whether a business or an individual person, okay? Now, for businesses, you are not required, but if you are trying to apply for a business identification number, this is the form you're going to be looking for. It's the you can find this on the irs.gov website. Just type in SS-4 form, and this is going to be applying for your employee identification number. Now, signing up and getting your business license is a requirement before getting your employer identification number. Now, the great thing about going ahead and signing up on the website to establish your business license is you actually get this form automatically. So then once you get your business license, you should be able to also apply for your employer identification number if you upon approval. Okay, so again, this one, again, you can use it, right? Because the purpose of having an employer identification number is a means for you to identify yourself as a business, but also to keep track of yourself as for any taxes that you have. So again, especially for employee taxes, you can have it for excise taxes or even alcohol and tobacco taxes. Okay, so any kind of taxes that you have to pay the federal government for, you should be using an employer identification number to go ahead and keep track of it. Now, if you are going to be using this employer identification number, just make sure you know the rules and regulations, because if you miss a payment from the federal government, they will give you a hefty fine, and it's no joke. Right? Especially if you owe money to the government, depending on what kind of organization you are, and you didn't meet the required time frame. Depending on if you're a really, really small business, you can get away with paying at the end of the year, but at the end of the day, you're gonna know that you're gonna have to pay at the end of the year regardless. If you're a major corporation, you might be having to file these taxes every single month, and we'll talk about that when we talk about the Form 940 and 941s and all of that. But in this case, that is something that you should know, that these forms this employer identification number is very important to file taxes for you for the federal government. Okay, so let's talk about having employees. Okay, employees, these are the different types of employees that you can have in a business. Now, there's actually more than this. It's beyond than this these 6 that you see here. If you want to know more information about those different types of employees, I do encourage you to go to irs.gov/publication15, and that's going to outline every single employee. So they'll talk about employees who are family members, right? You actually have to treat them a little differently. And then other situations are going to be like agricultural workers, people who work those temporary work jobs and things like that, right? Much goes way beyond that. But in this case, I'm just going to talk about these exact 6 here, because these are the most common ones that you would normally see here currently right now, right? And the most 2 important ones you need to know is only 2 out of these 6 types of employees actually will exist on your payroll list. Okay, so that means your common law and your statutory employees are going to be the only people that are going to be on your payroll. Everybody else is going to exist as a mere expense to your company. Yes, question.
What does statutory mean?
Statutory, uh I know what it is in terms of what kind of employee it is, but in this case, if I have to define statutory, I can't give you the exact answer right now. But in this case, yes, we'll talk about what a statutory employee is, but I won't be able to identify what statutory means. Okay? All right. So anyways, so these 2 types of employees are going to be the only 2 that exist on your payroll, and then the last 4 are going to be mere expenses to your company, all right? So let's talk about those different types of employees. So the first one we're going to talk about is your common law employees, right? Your regular workers. How do you determine that they are your common law or your regular workers? You should have 100% control of what they can do. Okay? So in this case, right, it's going to be judged upon how much control you have over the employee is going to determine what kind of employee status that they have, right? So in this case, usually for regular common law workers, you get to tell them when to come in, what to do, how to do the job, as well as the as well as you give them the job description, right? It has to be for the specific person, right? So for instance, right, you there is a difference between the president and the vice president and the treasurer, right? Those are all three different positions that contribute to the company, but they all do a very specific task for those specific jobs, okay? So in this case, it's 100% control over your employee. So in this case, right, that means you have to tell them the exact job that they have to do and tell them exactly how to do it, when to do it. So for instance, a common law worker would be someone who comes into the office Monday through Friday from 9 a.m. to 5 p.m. Okay? That's it. Straightforward, right? They're told exactly when to come in. And then when that employee comes in, what maybe they're a they're in charge of the cash register. They just have to be in charge of the cash register because that's the exact specific task that they were given. Okay, how do they do the job? Well, you have to provide them the materials. You have to train them if they need to be trained, and then so on and so forth. So in this case, you have full control over how the job is being performed, what the job is being done, when the job needs to be done, and so on and so forth, okay? So that is a common law employee, okay? Right? So now let's talk about the difference between a common law and a statutory employee. A statutory employee, right, has the same idea. The only difference is the outcome, or in this case, the end result, is going to vary, okay? So a great example is going to be, for example, a delivery truck driver, right? You can tell them what to do, you can tell them how to do it, and you can tell them when to do it. The only difference is because the job varies, because once again, a delivery truck, if you tell them to be here by 10 o'clock at p.m., they might not be able to make it back at 10 o'clock p.m., right? Because of traffic, there could be an accident on the freeway. There could be many different contributing factors to why that delivery truck isn't going to make it to your store in time. So therefore, that is the idea here, is that this is a great example of a statutory employee, is you are still told for them to get the task done. You are told them when to get it done, right? Like come in on Monday and pick up all of the groceries and deliver them to my store. But at the end of the day, the end task is what varies, okay? Right? You don't have control over when the actual task is going to get done, okay? So that is the crucial portion of understanding the difference between a common law and a statutory employee, because a common law, right? You tell them your job needs to be done every single day by 5 o'clock p.m. Boom. You clock in, you clock out at 5 p.m. In this case, you can't determine when they can finish the job. All right, so that's the huge difference between common law and statutory employees. So again, another great example is going to be a full-time life insurance. Okay, they could be selling their own product, but at the end of the day, right, when do they get to clock out? Well, that's when they ever make a sale, right? And then of course, any worker that works at home, usually, right, they have free range of when they can get the task done. All right. So again, anybody that is typically one of those. Now, why is it so important to know that these two employees and what makes a difference for them? It's going to be telling us how we pay them and what we pay them for. So in this case, your common law employees, right? You're going to be paying in part of their FICA, which is their federal Insurance Contribution Act. Okay, so that means their Social Security and Medicare. However, your common law is going to be subjected to the federal income tax withholdings. It's a requirement for your common law workers because they have a steady schedule. They come in Monday through Friday from 9 o'clock and clock out at 5 o'clock, right? They have a constant, consistent schedule. So they are required to, by law, to have to contribute to their federal income tax withholdings, and then, of course, their FICA, which is their Federal Insurance Contribution Act, which we'll talk about, Social Security and Medicare. Okay? Now, of course, if the common law has that exact one here, what's the difference between that and the statutory? Your statutory, since, because, example, a truck driver, you can't expect them to drive 5 days a week. You got to give them time off and so on and so forth. Maybe they have to drive over the weekend, etc., right? They do not have a consistent schedule. So in this case, right, because you can't determine when they will finish the job, they're going to be paid differently, and of course, they're also going to not be responsible for paying into their federal income tax withholdings. However, you are required of them to pay into their Federal Insurance Contribution Act. So again, Medicare and Social Security, okay? So that's a huge difference here. That's why I had to make the difference, because when you have these individuals on your payroll list, that's the difference of how you pay taxes for them, okay? Yes, if you have a situation where you have a truck driver and they do meet that requirement to fit under a common law employee, then of course everything is going to be applied to that common law. So again, I'm just giving you an example of what you can have if you prefer to have a statutory employee versus a common law employee. Okay? Any questions so far?
No, we're good.
Okay. So again, these two are individuals that you are going to be responsible for not only paying for compensating them, you're going to be also responsible to pay into their federal taxes as well. And we'll talk about what those federal taxes are when we finish up the whole process with all the employees, right? So again, your common law and your statutory employees are going to be the only two types of employees that are going to be on your payroll. Okay? Everybody else are going to be just common workers. Okay? Now, the third worker, okay, they're technically not employees, okay, but when we talk about employees as a general statement, we understand that employees mean that they work for you, right? Great, and they do work for you. The only difference is their status isn't going to be an employee that you pay on your payroll, okay? So that's the fundamental difference here. Now, in this case, the third type here is going to be a statutory non-employee, okay? So they're in this case, statutory non-employee is going to be determined based by, again, that you're gonna pay them for the job that they do for you. But the situation is that because they are a statutory non-employee, you don't need to be paying into any federal taxes for these individuals, okay? Like I said, they're just mere expenses to your company. So what's the difference between a statutory and a statutory non-employee? In this case, a great example is going to be a real estate agent, right? Because we talked about how do we determine the difference between our employees. It's based on how much you can control them. A person who's part of a real estate agent doesn't require them to have to be in the office every single day from 9 to 5, right? They get to choose the hours that they work, and their tasks is going to vary because not everybody is going to be buying a home at the exact same time. So it's going to be based on a per person, per case scenario, right? For real estate agents. There, you might have someone who just comes into the office for any walk-ins. Maybe they want to schedule an appointment. That's why you see normally real estate agents, they'll be putting up their advertisements to say, hey, you're looking for a home? Call this person. And that's what I mean by having that type of person. They aren't required to go into the office at a specific time. Their task is going to vary because once again, right, even though their job is to sell a home, they don't always have to sell the home. They might not be the only person that sells the home or be that person that gets in contact with the customer. So in this case, that's another control thing. Even though their task is the same, right? So for every real estate agent, your goal is to sell a home and you get to make money off of that, right? At the end of the day, the end result is also different as well. So there you go. It all has to do with the amount of control a company has. In this case, anybody who's a statutory non-employee has a little more freedom in regards to what the job that they can do, right? So another example would be direct sales agents, agricultural workers. So again, that one's going to be different, right? But direct sellers, right? People who go door to door and sell and try to sell, the company's products to those individuals, right? Direct sellers. They're going to be definitely statutory non-employees because, again, they get to determine when they get the job done, and the task is all the same, but the difference is the end results and when they want to come into work, and so on and so forth. Okay, and again, they must fill out a 1099 form and classify themselves as a non-employee. All right, and of course, they are liable for their own income tax withholding. So they are responsible at the end of the year to file for their own personal taxes at the end of the year. Okay. So again, yeah. So that's a statutory non-employee. Now, what about an independent contractor? Independent contractors are very, very similar to statutory non-employees. And here's the difference, right? The difference here is when you have these individuals who work for the company, they are going to be determining the end result. So that's the difference between a statutory non-employee and the independent contractor. The statutory non-employee, the end result is all the same. The goal is to sell the home. For the independent contractor, every individual person is going to give you a different result. So they get to come into the office whenever they like. They get to, their task is to do the job, but the end result is what's different between every individual person who works for your company. So a great example is going to be a doctor's office, a dentist's office, the vet, right? Because every doctor serves a different opinion, right? Every doctor is going to treat a customer or a client differently because, different set of eyes, different set of opinions. You get the picture, right? In this case, that's what's different between the employees is they get to determine what the end result is. So again, if you go to a doctor's office, you might see one doctor and they give you one result. You can say, I want a second opinion. Another doctor will come in and analyze you and give you their second opinion, right? So that's what I mean by different results, different even though the task is the same, right? You go into the doctor's office, you come in because you have a cold, right? Every doctor's going to give you a different end result. One might treat you with some antibiotics, one might treat you with some different stuff, right? Maybe they might not even treat you at all. So in this case, that is the difference here for the independent contractors, is that they usually typically have a different end result for every individual that works there. So again, they also have to file a 1099 form under independent contractor. Okay, and again, they are not required to have to pay into federal taxes because they are responsible to be able to have to file it for themselves. Now, again, if they properly do not file their 1099 form, the independent contractor can receive a $600 penalty for the withholdings, okay, or 28% of their earnings. Okay, so they get taxed pretty high because, again, they know the company's not paying for them. they are responsible to pay for their individual income that they earned. Okay. All right, the last two different types of employees is going to be your temporary work agencies, and then, of course, your leased workers. So most temporary and leased workers are your actual independent contractors, except here's the huge difference. Someone else is telling you what to do. So in this case, right, temporary workers, right? So if you've heard of temporary agencies, what they are out to do is they are for a specific type of job that they just it's a short period of time that you work these jobs for. So again, these temporary work agencies, right? What they do is they are the ones who are contracted by these large corporations to help these corporations find the temporary work for a project, for, they just need someone to just be able to set up something for them. So they just hire some agency to do it instead of using their own employees to do it. So again, that's what a temporary work agency does is they do require that these temporary agencies, right, the company asks them to look for workers to complete a specific task. So in this case, the task is given, right? The end result should be the same. The only difference is the individual who is working for these temporary agencies do not have really much control because they are under contract. Okay. Now again, you do not pay the workers as a company. You pay the company who got you those workers. Okay. So that's a huge difference. So you don't pay the individuals at all. You just pay the agency for helping you find these individuals, and they're usually one price point. You say, I need X amount of employees, or I need X amount of temporary workers to complete this job, which is going to be for a month long. Okay? Then you could say, okay, I will give you $100,000 to be able to find these workers. That's it. Boom. You cut the check and that's it. And then the company the temporary agencies is going to be responsible to pay the people who signed the contract to be able to do that project and everything, okay? So again, not liable for any income taxes or anything like that because, again, they are just mere expenses to the company, okay? And of course, most temporary agencies actually become leased workers, okay? Or most temporary workers become leased workers, right? Where the company can provide a contract for anybody who works for the temporary agency. And what happens is that given with the time frame that they have those individuals who work at the company, right? There could be a possibility that they can buy out the contract from the temporary work agency and actually fully employ them. And then that's what's called a leased worker, is you are leased for a period of time, and what you're doing there is you're going to be observed and you're going to be required to do a bunch of tasks, right? Because again, the company's asking the temporary agency to look for workers and give them the task ahead of time. So in this case, that's what the company is doing, is they're finding these individuals, right? And once that temporary work agency finds those individuals have an option where they can work for you for a period of time, and if they prove that they are a comparable employee, then the company who hired them can give them a contract or buy out their contract so they could be an employee, right? And then we call those leased employees, okay? So again, if while they're under the contract, you still do not pay the worker. You're paying the agency who got that leased worker for you, okay? So that means you don't pay into anything for them because they're just another mere expense to the company. Okay? Any questions in regards to employees? So a little fun fact here. So if you are interested in wanting to get a job in accounting, there is a temporary work agency called Robert Half. I do encourage you to go ahead and take a look into Robert Half because they can find you a temporary job, which again, I've been hearing that a lot of individuals who do work at Robert Half, because of those companies are looking for those temporary workers. They also are those. They also have leased workers where they contract them and then they buy out those contracts so they can become full-time employees after that. So again, Robert Half is the accounting headhunter, we call them. Yes.
How do you spell that? Robert, Robert, and then the last name?
Half, like you split something in half. So Half. Yeah. Robert Half. Robert Half. Yeah. Okay. So in this case, that is the accounting version of the temporary work agencies. I believe you could also go to ZipRecruiter and be able to look up the other accounting temporary agencies, because that's going to get your foot through the door. Okay, so just a little fun fact there, okay? All right, so now that we went through all the different types of employees that exist right now, okay, let's go ahead and talk about how we initiate the payroll process, okay? So in this case, you can't just say, hey, I want to employ you, right? Because there are multiple steps it takes to get the individual to be set up for your company and so on and so forth, right? And what are your responsibilities when you have to pay for your employees? And then, of course, you have to look at your responsibilities as well for having employees, okay? So here are the steps. We're going to walk through the first side, which is going to be the employee side, okay? But let's talk about how we actually get those employees to be part of our company in the first place, okay? So the number one step that you have to initiate first is going to be signing them up to the Department of Employment, okay? So whatever your, depending on what state you guys are residing in this case, we're in the state of Nevada. So ours is the Department of Employment, Training, and Resources, known as DETR, okay? And then, of course, specifically, we're in the department for the employee department, okay? So again, that's just in the state of Nevada. Every state's going to be different, and what you're going to do is, as a company, you need to submit everything that you need to know about these individual employees, okay? So that means you're going to be filing a W-2 form, okay? Now, be careful, because as a company, when you apply for a W-2 form, right, your W-2 form is going to give you different results, okay? Because your W-2 form is going to list out everything you need to know about that employee. So you're going to need their employee name, their legitimate legal name. You're going to need their social security if they, for tax purposes. And you're going to need to know and define what tasks and obligations that individual does, as well as pay rates and things like that, right? Those are obligations, because in this case, you need to officialize, right, that they are official employee for the company, and you have to have them recognized, okay? In this case, we're not paying anybody under the table, okay? This one's legitimate because these individuals are going to be the people that you are responsible to pay into their taxes and everything else, okay? So in this case, you have to, as a company, register them through the state. You can also register through them, the IRS as well, through the W-2. Okay, so you're gonna need to know all the employees' information. So again, usually when you have an employee that works for you, you also go through your own company policies and series of things, right? You have to go through. You gotta get a copy of all of their documentation. So whether it's a birth certificate, driver's license, state identification, or and social security card, whatever it is, right? Whatever whatever documentations that you need to have copies of, so you can submit these W-2 forms to the state and the government and the federal government. Okay. And of course, if you require anything such as a drug test or to be fingerprinted, then that's gonna be a company policy, right? That's something that you have to enforce as a company, right? So in that case, that's where you need to have all the information so you're able to fill out the W-2 form. Okay. Then the second thing that you're going to end up requiring is your employee is going to fill out a W-4 form. Now, as you can see, this is the W-4 form for 2022. We're reaching the end of 2022, so that means there's going to be a new form coming out sometime in December for the new following year. So in this case, whether you guys are going to apply for the job anytime soon, this will be the form that you're using, or if not, you'll be using the new 2023 form. And like I've mentioned before, right, the W-4 form is completely different from what we used to be having back in the past, okay? And I'll go ahead and show you the copy of the W-4 form, right? You can get this at irs.gov / in this case, no slash. You can go to the irs.gov, and then on that website, you're going to locate the W-4 form, which is going to be under forms. So I can show you that website right now. So if you are interested into locating this, now the employer usually should be providing you this this form itself. But in this case, and they are also able to help you file that form as well in case you do have questions. But the irs.gov also gives you a way to also help you file or fill out that form as well. So again, when you're here at the irs.gov, here you're going to go click on forms. Okay, and as you can see, by just putting my mouse on here, you're able to find your forms that you need to file for. So there's your form for W-2, form for W-7, and then of course you have the very first one's the W-4. So you could also click right here, or when you get to there, they have an actual form filler that you can utilize for tax purposes. Okay, so again, there's a bunch of different forms that you can look up from irs.gov. But again, these things should be provided by your employer, and they should be the ones that's going to help you be able to fill out this form. Okay. All right. So now that we talked about where to get it, let's actually talk about the new W-4 form. Now, in this case, they actually changed everything since 2020. So, beginning of the pandemic, right? They decided that we need to change up the new W-4 form for 2020, and then it's going to be continued on for the rest of the years to come, right? So in this case, the last time that you've ever seen a withholding will be 2019, all right? So that means now that it's fast forward so many years, this is how the new W-4 form is going to be filled out. So in this case, for you guys who are future employees or current employees, this is the form that you're going to be filling out, okay? So again, of course, you're going to have your name and your address on here. Now, this is where you have to fill out your filing status. You do not claim withholdings or points or whatever it is, right? You just have to fill out, and there's only 3 categories, so you can't even claim yourself at all in this case. So you have only 3 options that you can file your status as. So either single or filing separately, or you can file married, both filing jointly, and then of course you can also file as head of household. Okay? Now in this case, if you are going to be filing married and jointly, then the next section is going to be box number 2. Box number 2 is going to say if you're going to be filing as married and jointly, you need to report every single possible ways of generating income. So if you're going to be filing together jointly as a married couple, you have to consider the spouse's income as a secondary income. So in this case, that's what exactly I'm going to say here is that for the second one, if you are filing together jointly, you have to report your spouse's income. Okay, so that's section number 2. But section number 2 is taken into consideration because look at today's society. What is the possibilities of an individual having multiple jobs? This one is definitely more prevalent because now we have things like Uber, Lyft, Postmates, right? Having a regular job, right, from your 9 to 5 and then working that extra hours to get that extra income is going to be reported here for your secondary, tertiary, and if you have a fourth job, well, then you can also put that extra income in here. So this is asking you to report every single penny that you earn, okay? Now, if you have only one primary job, you can go ahead and not check mark section 2 and move on forth, okay? Because if you only get paid from one income, then you don't need to report anything else. But that's what section 2 is going to entail, is that any individual who works multiple jobs and has multiple incomes or is, filing as married, right? They need to take into consideration of their spouse's income as well. Okay? Now, why is this so important? Well, this is important because back then, when you had multiple jobs, back then, you would have to fill out a W-4 form separately for every job that you're applying for. In this case, they decided to make it more easier on those individuals, and instead of reporting a W-4 form for every single individual job with all those different numbers, you're putting it all together in one form, saying this is the money I earned from Uber, this is the money I earned from Postmates, this is the money that I earned from my primary job, so on and so forth, okay? So you're having to record every single source of income here, right, from your job, okay? So that's that section there. Then section 3, now if you remember, back then, in your W-4 form from back then, you had to mark for every child that you're going to claim as someone that you're going to have a dependent as, or someone that you want to claim as, right? In this case, they say no, 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 no. You're not going to claim one withholding per child. You're actually going to calculate how much each individual child is going to be. So any child that is under the age of 17 is going to be, it's going to cost you a total of $2,000 per year. Now, of course, we all know a child does not cost $2,000 per year. They cost way more than that. But what the government is saying is this is the bare minimum that they can cover, or that they can allow you to collect up to $2,000 for that individual. So again, if you file taxes and you claim your children at the end of the year, sometimes you'll get a tax refund, and that's what that money is for, that $2,000 per child scenario. So in this case, however many children that you claim under the age of 17 is going to be $2,000 per child, and that's where you're going to fill that section out. Okay, so how many children are you claiming? Okay, now again, you don't need to claim it now, because if you choose to withhold it at the end of the year, which you can, especially when you talk to your tax accountant, you can claim them at the end of the year. You don't have to claim them during the year. Okay, because during the year, if you claim them, you have a higher chance of having to pay back the government versus than getting a tax refund. Okay, because you're requesting money to be withheld from your paycheck. So if you're going to claim your child, that means you're going to get more money for your paycheck. That means more possibilities that you're going to more likely owe the government. So in this case, that's the first line there. Any dependent, doesn't matter what age, okay? Now again, there is a rule here. Any child over the age of 17, so that means 18, right? they are legally to be able to start working for, they could just start working, right? So that's why it is significantly less for those dependents. Now, I believe the rule is you can only claim your child up to the age of 26, right? Because they're at that point a full grown adult. They've already gone through college, assumingly, right? And they should be having a job by 26. That's the idea if you choose to claim those individuals. Now, if you have individuals with disabilities, you can still claim them as long as you'd like. Your grandparents who are elderly, you can claim them at some given point in time. Yes, you can. All right, you can complain them. You can claim them as dependents if they're living under your household, so on and so forth. Right? There's a lot of rules and regulations. You just as far as that, I'm not a tax accountant, but I can tell you that much information. So again, when you speak to a professional tax person, they will tell you what you can and cannot claim. Okay? And they'll even recommend you what you can and cannot claim. So in this case, are any individuals who are above the age of 18, right? Or whatever that you want to claim as a dependent, you can only claim up to $500 per year. Okay? Because again, anybody that's in the age of 18, right? Yes, they are legally able to be working. So you won't be needing to claim as much money on those individuals. Right? That's what they say. All right? So that's section 3. And then section 4 is going to be any other income. So that means if you have stocks, if you have other things such as bonds, money markets, or something that has some kind of personal savings, you need to include it. Okay, so if you're investing in stocks, that's other income that you can potentially claim. So that they even ask you for those kind of information. So if you have those extra income, you're going to need to report that as well. And then this next one here is going to be any other withholdings and deductions. So again, for head of household, if you want to claim your house, that's the perfect portion where you can claim your house and other deductions or any other expenses that you can claim. Now, like I've said, I'm not a tax accountant, so I cannot tell you this, but other deductions will be anything like garnishes. So maybe you are on parole, right? You might have to pay back the government or whatever case that you're filing a lawsuit against or someone filed a lawsuit against. That's going to be considered a deduction, including anything that has to do with a divorce. So child support, alimony, right? Those are all going to be deductions to your paycheck. Okay? And of course, at the end of the day, then any other extra withholding. So that is how you fill out your new W-4 form. So it's definitely much more complicated than you think. It's not like you get to claim one for this withholding, one here, one here, one here, add up your total withholdings, and boom, you're done. No, this one is going to be very specific on the amount of income that you earn, on the amount of children that you claim, and so on and so forth. So it's looking at per dollar case scenario. So in this case, I would say this is actually 100% much more accurate. Okay? Instead of saying, oh, if I claim myself and I claim 3 children and I claim my house, they're all going to be $179. No. No. In this case, this is a lot more accurate because it's actually like looking at every individual case and asking you to actually calculate it dollar per dollar. Right? So that's why they have, if you look here, it should say right underneath here that you can use what's called the W-4 tax generator, right? So it will tell you right here, this irs.gov tax generator right here. This is going to make it easier for you to file and fill out the form because it will give you a series of questions and you answer them. And what happens here is it will help you generate the W-4 form. So if you, again, especially because it's irs.gov, instead of going to seek an actual professional tax advisor and have to pay for them, you can go ahead and use the free tax generator for you on the irs.gov page. And it will, again, it will say how many children you want to claim, and you you know, you you file according to the answers that you the questions that you answer. So in this case, it breaks it down for you, so it's much more easier to understand instead of having to know every single individual item here. Okay. So again, any questions for the W-4 form?
Yeah, we good.
Okay. So it is a requirement for every employer to collect a W-4 form from those individual employees. Failure to collect one will mean that you can go ahead and subject to tax your employee at the highest tax rate. Oh, I'm sorry, I'm clicking the wrong one. At the highest tax rate. So that means zero withholdings, zero deductions, zero everything, right? And you're going to get taxed at the highest amount possible. Okay, that's failure to collect a W-4 form. And again, how often do you pay your employees? Well, if you pay them every 2 weeks, then that's going to be effective immediately if you do not collect this information as soon as possible. Okay, now again, that's why usually what they do is they require that the employees do fill this out at time of when they're filling out everything else, right? Applying for their fingerprint and all that, right? They have a period where they require their employees to fill out the W-4 forms, so they have this information so they can be able to take out the taxes as usual, right? But if you don't know what you're doing, safest bet is just to do zero tax at zero everything, just because then, again, you're more likely to get a tax refund because you're paying as much of your paycheck to the government, and then they'll go through your taxes at the end of the year, and you're more likely to get a refund than you would if you start claiming all these different claims, right? But then again, that's just again, when you're looking at if you are the head of household and you need that extra income to be able to provide for your family, to provide the house and things like that, then that's going to be the necessary steps that you have to take. Okay? So now we need to determine the payment period or the pay frequency, right? So oftentimes what you normally see in a typical business is you'll often see weekly, bi-weekly, and semi-monthly, okay? Now, the other ones, we'll talk about every single one. So again, weekly means you get paid every week, okay? So oftentimes you'll see normally everyone gets paid on a Wednesday or Thursday or Friday, and they get paid every week, okay? And then you'll see bi-weekly means getting paid every 2 weeks. So again, this is typical for a lot of companies because they pay them every other week. Usually it's on Fridays, right? And then of course, anybody who's a salary earner typically would have a semi-monthly where they get paid on the 15th and then they get paid on the end of the month. So 30 or 31st of the month. Okay, or it would technically be the first of the next month. So in this case, that is what I mean between the differences. So weekly, you get 52 paychecks for the whole year. Bi-weekly, you get 26, right? Because there's 52 weeks. You divide that by 2, you get 56. Or sorry, you get 26 paychecks, right? Where semi-monthly, since you're going to get paid twice a month, you're going to get 24 paychecks. Okay, so that's usually the more common ones that you would see in a normal business out setting, right? This is how you normally get paid. Now, yes, you can offer to pay your employees every day. So, for instance, right, Uber allows you to clock in your hours and claim at the end of the day. So you could get potentially paid every day. Other ones is going to be like, for example, individuals who actually work for the company that are like higher ups, officers, or things like that. They can get paid monthly. Okay, so we all for instance, anybody who is a recipient of government assistance, usually you get paid every monthly, right? It's never the other three. right? It's usually you get paid either at the beginning of the month or at the end of the month. Okay. Now, other ones that you normally won't see would be quarterly. I don't know anybody who would want to get paid every quarterly. Maybe for those individuals who are, for instance, a higher up that maybe they do, maybe they're just a sales representative that does their job every other like month or so. So they could get paid quarterly, semi-annually. Most likely not. You're not gonna. No one's gonna want to be paid every 6 months. And then last but not least, annually. Annually, no one's gonna be want to paid at the end of the year. But usually, typically, payroll or in this case, you for salary earners, it's usually measured in annuals, right? They usually say you can make $50,000 per year, right? And then of course, when you break it down by the different payroll periods, then you'll figure out that every paycheck you're going to get is X amount of dollars. Okay, so usually measured in annual. Okay, but the more common ones that you would normally see is weekly, bi-weekly, and semi-monthly. All right. So now that we finally have gotten through the whole process of getting your employee through the door, right? Setting them up, and then now figuring out how often you're going to pay them, right? Now we need to determine how you're going to pay your employees. How much are you going to pay your employees, right? So in this case, right, you have the option to either choose to have wage workers or salary earned workers, okay? So wage ones are based on an hourly rate, right? So they get paid by the hour. And of course, you can, allow them to be able to collect other types of payments, such as, for example, they can be overtime, they can be commission based, you can add some bonuses to them, okay? Now, here's something that you should also know as well. Tipped workers, okay? So, yes, you can apply the tips to someone's paycheck. Yes, in most cases here in Nevada, because we know that it's Vegas is known for the hospitality on the strip. A lot of them are tipped workers, so they get paid. And then some of those tips are reported depending on the company. They do require the employees to report their tips. Some of them do not, right? Just depends on the company. And some of them get commission based, or some of them get other things, right? So again, other ways you can earn, again, is going to be any overtime, sick pay, holiday pay, vacation pay. All of those are going to be extra benefits to your pay. But in this case, I'm just looking at what the basic ones are, okay? And of course, for salary earners, it depends on your company's status. Some of them can provide overtime. Like, for instance, like maybe their set number of hours. If you meet that set number of hours under salary-based earners, then you can also collect overtime. Most cases, they have bonuses and commissions, etc., etc. And usually they get paid the same exact amount every single paycheck. So in this case, it doesn't matter how many times or how much hours that they put into the company. And of course, when we're looking at this, since we're in the state of Nevada, we have to follow the rules and guidelines on what the minimum wage is. Now, in this case, I forgot to update this again. The minimum wage is currently right now, I believe it's $10 right now. Because I believe after the pandemic, they increased the minimum payment now. So I'll change that later on. But in this case, back in 2019, it was $8.25. Okay, so that's the minimum wage. So again, depending on the state that you are doing business in, you do have to have that as a federal requirement, state requirement to pay your individuals for their job. Yes.
Okay, you're saying that the minimum wage
Hmm.
is 8.25 now, or
No, no,
is
no,
it?
no. That back in 2019 it was. I haven't changed it to now. To now it should be $10. Ten
So that
dollars.
means is that the state minimum wage or the federal minimum wage?
Okay, so federal requires the state to have a minimum wage. Okay, but the state determines how much they want to pay based on the cost of standards of living. So in this case, the state determines how much the individual can earn based
And so,
on the cost of living.
but they still have it but as far as the base of the basis of the federal income, they still showing 7.25.
Is that true?
I still see it on some of uh the the places, not unless they change it. But as far as I hear, it's still 7.25 an hour for the minimum,
For the federal.
according to the federal.
Okay. All right.
But but the state, if the state is $8, or at this time as $8.25, well,
Mm.
that's it.
Yeah, because again, because it depends on the state that you're working in. So in this case, I didn't put any federal information here just because we're looking at the state. The states is going to be wherever the job your job is going to be working at. So whatever that they tell you the state requirement is going to be whatever the minimum requirement is. Now that doesn't mean that every job is going to be at $8.25. No, it's just the minimum that they have to pay you is the requirement. Now, yes, there are some rules and regulations that you do need to know about minimum payments because if, for instance, you have a tipped worker who puts their tips into part of their earnings, they can fall below the minimum wage. Yes, because they're having extra income to make up that minimum wage. Yes. Question?
No, no question.
Oh, okay, I heard another ding. Okay. All right. So yes. So for now, the state is what we're going to be actually looking at, and then because the federal is going to require the state to have a minimum payment. Okay. But in this case, the state is what's going to be the one that you're going to be looking for because it depends on where you're working, in regards to the company that you're working in, like what state they're actually operating their business in. So in this case, the state here in Nevada, well, right now it's not 8.25 or it's not $8.25 anymore. It's way more than that. Okay. All right. Okay. So let's talk about how we determine our employees' paychecks. So again, other types of benefits and deductions. So if you have fringe benefits, okay, what are fringe benefits? Fringe benefits are those extra perks that when you work for a company, right, you can get extra perks and things because you're working for that company. So, for instance, right, um, a perk would be uh, maybe you can get your car insurance for AAA to be significantly lower. Maybe you can get your phone bill a little lower because you work for this company. So that's called a fringe benefit. Okay, it's a benefit for working for the company. You get extra perks because you're working for that company. Okay, you can also have holiday pay, which is a benefit. Okay, vacation pay, so we have PTO, sick pay. Other than that, you can have retirement benefit plans. So again, if you have a 401k plan, okay. Other than that, you can also have medical insurance, whether it's health, dental, vision, life insurance, whatever it is, if you offer that to your employee. Now, again, if you offer these to your employee, you have to consider how are you going to split the difference, right? Are you going to match them 100%? Are you going to have them cover 50-50%? Or are you going to, again, do dollar per dollar, right? How are you going to do that? So that's what you have to also decide as well. Now, how do you collect the information from your employee? Well, that will depend. Are you going to have your individual employees have in a clock in and clock out tower? Are they going to be responsible for keeping track of their own records by submitting you a form, right? How are you going to keep track of the hours for each and every single employee, right? That's how you're going to go ahead and be able to pay your employees based on how you are going to be recording them and reporting them, okay? All right, so let's see. So let's spend the next 20 minutes talking about the employee taxes. So, as a employee, you are responsible for every penny that you earn, you are responsible to pay into the federal taxes for working at the company, right? The federal are obligations. State will depend on what state that you're residing in, and and second of all, if it's required, right? So here in the state of Nevada, there are no state taxes, okay? But if you're working from another state in the state of Nevada, you are subjected to pay whatever state tax is required in the state that you live in. Okay, so remember, it's based on residency, not the place that you are working. Okay, now that will also depend because there are some rules and regulations that can be bent. So, for instance, professional athletes, right? They actually earn the money based on the state that they did the job in. Okay, or they get taxed at the state that they completed the job in. Right, but that's again individual per case scenario. But in this case, if you are working out of state, whatever state that you reside in is the taxes you're going to pay for. So, for instance, if I live in the state of California, I reside in California, and I'm working in Nevada, I have to pay California state tax. Okay? Even though Nevada doesn't have any state taxes, you're required based on where you reside. Okay? So, now that I talked about state taxes and Nevada doesn't have any state taxes, so now let's talk about federal. What are the federal taxes that the employee is responsible for? So in this case, first one you have to know is federal income tax withholdings. So that is exactly where the W-4 form comes into play, because the W-4 form basically tells the employer how much to withhold from their paycheck. Okay? So again, every year the IRS releases a new bracket. So again, we're going to also be needing to use some kind of tax bracket, tax tables, right? And that's where I'm going to introduce you to the circular E-table. Okay, so that's how you're going to determine the federal income tax withholdings, right? Again, we also know this as well. Higher taxes means higher wages means higher tax percentages. So let's go ahead and talk about the two different methods that you can calculate your federal income tax withholdings. You have the percentage methods, which is a more accurate calculations, where you're going to utilize a tax table to determine what percentage that you're going to be calculating the individual's income tax withholdings by, and so on and so forth. Where the bracket method, right, you're going to determine what your total amount of income is and your total amount of withholdings, and you're just going to use the tax table and locate where the amount of tax is. Now, the bracket method, it's very easy to do, so I'm not going to teach that one, okay? And then on top of that, their numbers that are in the brackets are going to be rounded. Now, in this case, with the percentage method, you're going to get a much more accurate table. So in this case, we're going to be looking at the circular E-table. Okay, so what is the circular E-table and how does it look like? So this is what you should be getting from the IRS.gov. It's called Publication 15-T, and this is going to be your federal income tax tables. Okay, and it depends on which method that you're using. Okay, so in this form or in this page here, you have about 5 different types of tables that you're going to see. Actually, no, I lied. Excuse me. you have nine tables in here, okay? So the first one here is your percentage method for automated payroll services. So again, when we talk about QuickBooks, we'll talk about what this table is for, okay? Because this is for payroll services that use automated calculation systems. So that's this table here, all right? And then you're going to see the second one's going to be the bracket method for W-4 Form 4, 2020 or later. So it's going to be broken up into the different types of federal W-4 forms that you submitted. So anybody who submitted a W-4 form prior to 2020, they can still continue using that W-4 form. However, the calculation is going to be different because you only submit a new W-4 form to the employer if some life-changing incident has happened to you and you need to claim or you don't, and you have to change your information. So that's the criteria there. So this is the bracket method. We're not going to use the bracket method because it's very easy. You just determine what it is and then find the location, and then you'll be able to find it. Okay. And then here, this is the tax table you're going to be using. You're going to be using the percentage method. So I'm going to teach you how to use the percentage method for manual payroll systems, okay? With individuals who file for the W-4 form for 2020 and later. Why? Because we're living in 2022. So anybody who's going to be applying for a job now is going to have to either file a form for 2020 and later, right? You can't file a 2019 form to an employer for if you're doing it right now, because unfortunately it has to be matching the same year that you actually are applying. So in this case, anybody who's a new employee is forced to be using the 2022 W-4 form. So in this case, since we're in the future right now, or not in the future, we're in the current time now of 2022, I'm going to show you how to do the percentage method for W-4 forms for 2020 and later. Okay, so this is the tax table you're going to be looking at. Now, right here is going to give you a step-by-step on how to calculate every single item on here. Okay, so it does give you kind of a way to be able to do this, but once again, it is very complicated. So I'm going to show it to you manually, but these are the tax tables, and they're going to be based on, number one, pay period. Okay, so this is the weekly pay period. Second thing is, it's going to be based on your marital status, right here. Are you single, or are you married filing jointly? Okay, and then third thing is going to be determining based on your how much money that you earn. Okay, it's going to determine which bracket and percentage that you belong in. Now, why is this split into two sections? If you remember for your W-4 form, if you have more than one job, you need to be on the right side. If you only have one job, you're going to be on the left side. That's as simple as far as is. Now, in this case, I'm not going to make it that much complicated. I'm only going to test you on individuals who have one primary job. That's it, okay? So we're not going to talk about the difficulties and the different calculations that you're going to get for someone who has a multiple job, right? Because most likely, commonly, you'll see more people having one job versus multiple jobs, okay? So you're going to be using the left side of this table once again, and it's going to be depending on the payroll period and their marital status and how much they earn. Okay. So that's the percentage method, and I'm going to show you how to calculate that right now. So here's the tax table for you. Okay. So these are the steps that you're going to be needing to take here, steps 1 through 4, or steps 1 through 5. Okay. I'm going to break it down for you right now. So, for example, right, we have L, okay? L is a single woman with one dependent, okay? And she only has one primary job, okay? And earns a total of $15.25 per hour and works a total of 45 hours this week. And of course, she also claimed her dependent and doesn't have any other extra deductions, okay, or withholdings. Payroll period is she gets paid every week, okay? And so now step 1 is to determine her total amount of earned wages. So how do we determine that? Well, if she gets paid hourly, she claimed 45 hours and her rate is $15.25. That's exactly what you're going to do. So $15.25 times 45 will give you a total of $686.25. So that's her total gross earnings, okay? Now, step 2 is going to be saying if they have extra income from other jobs or any deductions, then you're going to subtract that. Now, we already said she doesn't have any extra withholdings or any extra deductions or any she only has one job, right? So in this case, this second portion right here is going to say, well, you have to add any extra income, which in this case, she doesn't have any. And then the second one is subtract any deductions, which she doesn't have any. Okay, it's like she doesn't have any marital she doesn't have child support. She doesn't have any of those extra deductions. So in this case, there you go. 0 for that, so you subtract 0. So that means her total amount that is subjected to be taxed at is going to be that $686.25. Okay? So then now, step 3 is now going to determine what her what tax table that she's going to be belonging to. So in this case, we need to determine on her W-4 form what her marital status was. She said she was single. What was her pay frequency? We said that the company pays her every week. And what did she check the box in step 2? No, because she only has one primary job. So therefore, we need to determine which table on the circular E table we're going to use. So in this case, I've already mapped it out for you. It is the weekly pay table for a single filing or single or married filing separately. So in this case, we need to determine based on how much money she's earned. So in this case, she earned $686.25. So how you read this table is A is going to be at least. Did she earn at least $0? Of course. Yes, she did. Did she earn at least $241? Of course she did. Did she earn more than $433? Yes. Did she earn more than $1,021? No. So therefore, we got to back up and say, okay, so if we know at least she earned at least $433, but she's earned less than $1,021, this is the information that I'm going to be using to calculate her federal income tax withholdings. Okay? So how do we continue reading this? So C is going to be the total amount that the government's going to take away for taxes, regardless of amount of income that the person's going to make. So that means you're going to be subjected to $19.20 tax right away. Right? D says plus the amount that you are going to have in excess in. So in this case, she's going to be subjected to 12%. 12% of what? 12% of every dollar that she's earned in excess. Okay? And letter E is going to be how much money she gets to keep without being taxed, and every dollar that she's earned over that is going to be in excess. So in this case, she gets to keep $433 without getting taxed. So let's go ahead and figure out what the calculation is. So you're first going to start out with letter E, right? You need to determine how much money she's earned in excess. So we said that the government lets her keep $433. So therefore, $686.25 minus $433 is going to give you $253.25. Now, if you remember, letter D said that you're going to be subjected to a 12% tax, right? So that's exactly what this percentage method does is because she's on that bracket, she's going to be subjected to 12% of her extra income. So in this case, we're going to take that $253.25 and we're going to multiply by that 12% to get $30.39. Okay? Then we can't forget what letter C does because letter C is going to tax her no matter how much she earns. So in this case, we're going to add that $19.20 to get a grand total of $49.59. Yes. Question.
Yeah. What was the 433 again?
433 is going to be Section E, which is going to be the amount that the government lets you keep. And that's what you're going without getting taxed, right? And any dollar after that is taxable. Okay, so that's the amount of money that we're trying to determine as the amount in excess. How much extra money did she earn on top of that? So in this case, the government lets you keep $433 tax-free. Any dollar after that gets taxed, whatever percentage that you are in the bracket for. So in this case, she's going to get taxed 12% per dollar.
Okay, cool.
All right. So now she's subjected at $49.59 as tentative tax. Now, because the way that the system works now, dependents are going to be taken out after taxes. Okay. Now, sometimes, depending on your income and your deductions, right? So, for instance, right, in this case, a child that you claim back then could be either taken out before or after taxes, but usually it's taken out before taxes. In this case, it's required that it's after taxes. Okay. So therefore, if it's after taxes, we have to go ahead and determine how much is that one child that she's claiming as a dependent, right? Because she said she is claiming that one dependent. And because her payroll period is weekly, we also need to know how much paycheck she's going to be earning. So in this case, she claimed one child, which was $2,000. And because we have to divide by the total amount of paychecks that she's going to earn, right? So in this case, on her W-4 form, it's $2,000. Yes.
What was the 19 again? 19 like 59?
You mean 1920? 1920?
Yeah.
Okay, that's the amount of tax that the government's going to take away from your paycheck regardless of the amount of money that you earn. So these are all fixed numbers. So these are all going to be taken out no matter how much you earn. Okay. So now that we determined that she claimed her one child, which is $2,000, right? We need to determine how many paychecks she's going to earn. Now, like I mentioned before, right, you should get that table where it tells you how many paychecks you earn in each pay period. So in this case, my weekly payroll frequencies, I'm going to get a total of 52 paychecks. So therefore, I'm going to divide the total amount of dependents, right? So $2,000 because that's the amount per year, and divide it by the total number of paychecks, which is 52. So therefore, when I do that calculation, I get $38.46. And what happens to this $38.46? It gets taken out from your total withholdings that you just calculated earlier. So therefore, she's subjected to $11.13 worth of federal income taxes, right? And the last one's going to be any deduction. So if she claimed her house or she has other things such as garnishes or, extra deductions or extra withholdings, then that's just going to keep taking. Now, the rule is if it goes beyond the amount of tax, then it's just zero. No federal taxes whatsoever. Okay. Right. So boom, That means she is going to be subjected to $11.13 of federal income tax withholdings. Okay? All right, good so far? Okay, so let's talk about this last section here, which is the Federal Insurance Contribution Act. Yes.
So the $11 came from the taxes withheld minus the deductions for the child.
Correct.
Okay, cool.
Okay. So now let's talk about employee FICA. What is FICA? So we talked about Federal Insurance Contribution Act, right? This is your Social Security and your Medicare, okay? Now, when we talk about Social Security and Medicare, so it is a federal requirement that if you work for any type of company, you are required to put in a portion of the money for your Social Security and your Medicare, right? They have different names that you can associate them with. So, Social Security is your old age survivors and in disability insurance. So OASDI, but it's most commonly known as Social Security, which is going to be 6.2% of your gross pay. Now, where does this number come from? This number comes from the irs.gov/publication 15. This is what the federal government deems that if an individual is supposed to be working, so they assume that everybody starts working about the age of 20 and their retirement age is right now, 67? Between the time of 20 to 67, between those 40 years of working, 6.2% of your paycheck should suffice you enough money for you to retire. Okay? So these numbers are preset. They're already been established by the federal government, and they say that 6.2% should be enough money to go ahead and put into a pension where the federal government's going to be issuing all those Social Security checks, right, for anybody who's claiming their, retirement age. Okay? Now, again, here's the problem. There is a cap limit on how much money you can contribute to. The cap limit, is going to be $147,000. The federal government deems that $147,000 should be enough to cover an individual, right? Because they're expecting an individual to die around the age of 80 or 90, right? Or 80 to 85 to 90, right? They're only expecting you to live for maybe 10 or 15 years, depending on the individual, right? So that's the life expectancy that the federal government says, and they think that $147,000 should be enough to cover that individual. Okay? And no, you cannot put more. So once you reach that cap limit, you don't need to put any more dollar into your Social Security. Now, that also depends on how much every individual person earns, right? So again, especially for those who do minimum wage, it will take you maybe 60 years for you to even get to that cap limit. Okay? But for individuals who have higher paying jobs, then obviously they will reach that cap limit a lot quicker. That's why a lot of companies, they would have other offers such as a retirement benefit plan for a 401k. So then when you do end up working for the company, not only are you receiving a check from Social Security, you're also getting another check from your company. Another one is you can also go to the bank and open up an IRA, which is an individual retirement plan, right? Where you can put in your own money in there, and that way you get to save that money for retirement. So there's a lot of different benefit plans that you can have for retirement. I'm just giving you an example that this is what the federal government deems necessary for individuals to have. Now, since it's based on gross pay, if L earned $15.25 per hour and worked 45 hours, she earned a total of $686.25. So multiply that by that 6.2%. She is subjected to pay $42.55 to her own Social Security. Okay? And of course, we're going to talk about the other section of Federal Insurance Contribution Act, which is known as Medicare. Medicare is 1.45% of gross pay. Okay, so once again, it's deemed that this was determined by the federal government, that they say that 1.45% of an individual's paycheck should be enough to pay for medical insurance. Okay, now again, here's what's awesome about the medical insurance here, Medicare. There is no cap limit, so you can put in and contribute as much Medicare as possible. But once again, that's only deemed on how many paychecks you earn and how long you've been in the company for. So 1.45% is going to be the amount that you're going to be calculating off of gross pay. So in this case, once again, if L earns $686.25, we're going to multiply that by 1.45%, and that's going to give you a total of $9.95. Okay? So now that we talked about how Nevada doesn't have any state taxes, so this is what we're going to be doing because we're living in the state of Nevada, right? You shouldn't be focused on any other state, because if you're going to be applying for a job, most likely you're going to be applying in the state of Nevada. So in this case, if the bare minimum, if the company is going to pay you bare minimum, that means you only need to cover the federal taxes because there's no state taxes. So in this case, that's exactly what I'm going to have you guys do. Is we're going to assume no extra benefits, no extra deductions, no 401k plans, no health insurance, none of that. We're only going to focus on just the federal taxes, and this is what you're going to be subjected to. So L, right, gets the $686, right? But that's not true. That's how much she earned. We have to deduct all the federal taxes that are going to come out of her paycheck, and then we're going to give her her net pay. So in this case, we need to subtract $11.13 to federal income tax. We need to subtract $42.55 for Social Security, and we need to subtract $9.95 for Medicare. So that means she's going to end up walking away with $622.62. Okay? That's the bare minimum. Again, when we talked about the extra earning, the number 2, extra earnings and minus all the deductions, if the company provides those extra deductions, usually they are taken out before tax. Okay? So again, if they provide a 401k plan, which is a deduction, any health insurance, that's a deduction. Okay? All of those extra things are going to be taken away from the paycheck. And then you're going to get taxed from there. Okay? So again, those are also going to be taken away from the paycheck as well. But like I said, if L is just a regular worker that gets no extra benefits and extra deductions, this is the bare minimum that you are going to be required to calculate for her federal taxes that the employee is responsible to pay into. Okay? Any questions so far?
Okay, we're good.